Picture this for a second. Two investors wake up this morning and check their retirement accounts. The first guy, probably that one coworker who suddenly thinks he's a Wall Street genius, is up nearly 100% this year because he loaded up on Nvidia. Every day he's talking about AI, telling everyone the future is obvious, and acting like anyone who isn't buying tech stocks is falling behind. Then there's you. You took the safer route. You invested steadily into a low-cost S&P 500 index fund. No chasing hype. No gambling on individual stocks. No spending your evenings glued to financial news channels. Just consistent, boring investing like every expert recommends. And your portfolio is up too. Maybe not as dramatically, but still doing well. But here's the part almost nobody realizes. You own Nvidia too. Probably a lot more of it than you think. In fact, inside your diversified index fund, Nvidia may represent a larger position than hundreds of other companies combined. You just never noticed because it was hidden behind the word diversification. I'm Ned, and I've spent an unhealthy amount of time digging into what's really driving this market underneath the headlines. And once you see the numbers, you'll understand why some of the smartest investors in the world are getting cautious while the average investor is celebrating record highs. So if you want to understand what's actually happening behind the scenes and why so many portfolios are far more concentrated than people realize, make sure to subscribe and hit the like button. Because today, we're breaking down the hidden reality of the modern stock market. This isn't another "the market is about to crash" video. Markets rise and fall all the time. That's normal. What matters is this. Most investors believe they own hundreds of companies, when in reality, their financial future is riding on a tiny handful of stocks. Let's look at the numbers. Right now, the S&P 500 is hovering near all-time highs. The Nasdaq continues setting records. The Dow has surged back above major milestones, and if you've been consistently contributing to your retirement account every month, honestly, you're probably feeling pretty good, and you should. Long-term investing still works. But here's the misconception. When people hear that the S&P 500 is doing well, they assume the entire market is thriving equally, that all 500 companies are pulling their weight. That's not what's happening. Today, just 7 companies account for roughly a third of the entire S&P 500. 7. Nvidia, Microsoft, Apple, Alphabet, Amazon, Meta, Tesla. Add a few more megacap names to the list, and nearly 40% of the entire index is concentrated into just 10 companies. To understand how extreme this has become, go back less than a decade. In 2016, those same companies represented only a small fraction of the index compared to today. Now their influence has exploded. So when people say they're buying a diversified S&P 500 fund, what they often don't realize is that they're heavily concentrated in a small group of giant tech companies, with hundreds of much smaller positions sitting quietly in the background, and the impact is enormous. A massive percentage of the index's recent gains have come from just a few stocks. Nvidia alone has driven a huge share of overall market performance. Think about that for a second. One company contributing an outsized portion of the gains inside millions of retirement accounts. So when I say most investors unknowingly own 7 stocks, I'm not exaggerating for effect. I mean it literally. Go open your 401k. Look at what's actually driving your returns. So go check your portfolio right now. Seriously, if your largest holding is something like a Vanguard S&P 500 fund, a Fidelity Index fund, or even a target date retirement account, then whether you realized it or not, you've become a major Nvidia investor. Not because you consciously decided to, not because you researched the company for weeks, but because the structure of the market quietly pushed you there over time. And that brings us to the real issue. The problem isn't just concentration by itself. Concentration only becomes dangerous when expectations get too extreme. And eventually something fails to live up to the hype. So the next question is obvious. How overpriced has this market actually become? And this is where the data starts flashing warning signs. There's a common valuation metric economists use to measure how expensive stocks are compared to the profits companies generate. You don't need to memorize the formula. The simple version is this. It tells you how much investors are willing to pay today for each dollar of corporate earnings. Historically, over more than a century of market history, that number has averaged around 17. Today, it's hovering near 40. And that matters because in roughly 145 years of stock market data, there has only been one period more expensive than this. The peak of the dot-com bubble in late 1999, right before tech stocks collapsed and many of the biggest names lost the majority of their value over the following years. What's even more surprising is that the market today is more expensive by this measure than it was before the 1929 crash that triggered the Great Depression. Think about that for a second. By historical standards, we are currently living through one of the most expensive stock markets America has ever seen. And there's another way to understand just how stretched valuations have become. Take the combined value of every publicly traded U.S. company and compare it to the size of the entire American economy. In simple terms, are stocks becoming disproportionately valuable compared to the economy that actually supports them? Right now, that ratio has reached record territory, higher than before the dot-com crash, higher than before the 2008 financial crisis. U.S. equities are now valued at more than double the size of the country's economic output. That's the financial equivalent of a single business somehow becoming worth more than the entire city surrounding it. Eventually, reality has to catch up with the price. So why are investors still willing to pay these massive valuations? One word: AI. Right now, the market's optimism is built on one gigantic assumption: that artificial intelligence will revolutionize productivity so dramatically that today's prices will eventually look justified. And to be fair, maybe it will. Maybe AI truly does reshape the global economy, but what's happening underneath the surface is extraordinary. The largest technology companies in the world are pouring staggering amounts of money into this race. Microsoft, Google, Meta, and Amazon alone are expected to spend hundreds of billions building AI infrastructure. Data centers, advanced chips, energy systems, cooling facilities, and the massive computing networks required to power these models. The scale is almost hard to comprehend. We're talking about spending levels comparable to the economic output of entire developed nations, all concentrated into a single technological arms race. And this isn't a one-time investment. They plan to continue ramping it up year after year. But here's where things get interesting. That spending spree is already starting to pressure profits and cash flow, because eventually every massive investment boom runs into the same question: when does the return actually show up? And the financial pressure is already starting to show. Amazon, for example, is pouring so much money into AI infrastructure that analysts expect its free cash flow to swing deeply negative this year, depending on how the numbers are calculated. In plain English, one of the largest companies on Earth is spending cash at such an aggressive pace that keeping up in the AI race is becoming enormously expensive, even for them. Microsoft has also admitted that a huge chunk of its recent spending increase isn't even going toward innovation directly. It's simply the rising cost of chips, hardware, and AI-related infrastructure. And investors are beginning to notice. When Meta announced another increase in AI spending earlier this year, the market reacted immediately. Billions in value disappeared in a single trading session as shareholders started asking the obvious question: how much spending is too much? Because beneath all the excitement, something strange is starting to happen. The AI economy is beginning to resemble a closed loop where giant tech companies are increasingly funding one another, buying from one another, investing in one another, and then counting all of that activity as explosive growth. Think about how interconnected this has become. One company funds an AI lab. That AI lab signs massive cloud contracts with another tech giant. That provider then raises enormous amounts of capital to build the infrastructure needed to fulfill the deal. Chip makers issue incentives and financing to AI companies, while other firms lease out the hardware powering the entire system. Money is constantly moving between the same small circle of companies. And on paper, the revenue numbers look incredible. But the deeper question is whether the underlying economics truly justify the scale of the spending. Because some AI firms are committing to future infrastructure obligations that are almost difficult to comprehend compared to the revenue they generate today. It's the equivalent of someone earning a middle-class salary signing contracts to maintain a billionaire lifestyle under the assumption that future success will eventually cover the bill. Now, to be fair, the AI optimists may ultimately be right. Unlike past bubbles built on pure speculation, these companies are real businesses generating enormous cash flow. Microsoft, Amazon, Google, these are highly profitable corporations with dominant global positions. This isn't the dot-com era where companies with no revenue were suddenly worth billions overnight. But there's still one uncomfortable problem. The returns on AI investment haven't clearly arrived yet. A recent large-scale corporate study examining real-world AI deployments found that the overwhelming majority of organizations still aren't seeing measurable financial benefits from their AI initiatives. Not disappointing returns, not weak returns, no meaningful returns at all. And that's the key issue. Right now, the tech industry is spending extraordinary amounts of money on the assumption that future productivity gains will eventually justify today's valuations. But eventually, investors stop asking what AI could become, and start asking what it's actually earning right now. And when that shift happens, the conversation around these valuations changes very quickly. But here's the bigger issue. We haven't even talked about the broader economy yet, because expensive markets can survive for a long time, but only when the economic backdrop stays supportive. So let's look at the environment surrounding all of this. Inflation has remained stubbornly elevated. Interest rates, which investors expected to fall aggressively this year, have instead stayed higher for longer. Just months ago, Wall Street was confidently predicting multiple rate cuts. Now those expectations have been pushed back, and some investors are beginning to prepare for the possibility that rates could move even higher instead. That's an enormous shift in sentiment in an incredibly short amount of time. And when markets are priced for perfection, changes like that matter a lot. Because high-growth stocks, especially the giant tech companies driving this market, tend to perform best when money is cheap, borrowing is easy, and investors are willing to pay premium prices for future growth. Higher interest rates change that equation fast. Suddenly, future profits become less valuable. Capital becomes more expensive, and the market starts demanding real earnings instead of just big promises about the future. That's when things can get uncomfortable. And the timing couldn't be more sensitive. Jerome Powell's tenure leading the Federal Reserve has come to an end, and the new leadership stepping in is widely viewed as tougher on inflation and more willing to keep monetary policy restrictive if prices stay elevated. So now the market is dealing with a dangerous combination: stubborn inflation, higher for longer interest rates, and stock prices that are already assuming almost everything goes perfectly from here. That's not exactly a comfortable setup. At the same time, long-term Treasury yields have surged to levels investors haven't seen in nearly 2 decades. And this matters more than most people realize, because when investors can earn around 5% lending money to the US government, considered one of the safest assets in the world, the appeal of paying enormous premiums for risky stocks starts to weaken. This is one of the most important relationships in finance. Higher bond yields increase competition for stocks. When safe investments suddenly offer strong returns, investors become much less willing to overpay for future growth stories. That's why rising yields are often described as gravity for the stock market. And right now, gravity is getting stronger. Then there's the debt problem. The US government is running enormous deficits, and the national debt continues climbing at a pace that's becoming harder to ignore. Even more concerning, the annual interest payments required just to service that debt have exploded. Think about that for a second. The country is now spending staggering amounts simply paying interest on money it already owes, not building infrastructure, not funding innovation, just covering financing costs. Some of the biggest names in global finance have started openly warning about the long-term sustainability of this trend. And whether you agree with those warnings or not, it's worth paying attention when investors managing hundreds of billions of dollars begin using phrases like debt spiral in public interviews. But here's where things get even more interesting. Because major financial problems rarely begin with one giant collapse out of nowhere. Usually they start with small cracks that most people ignore. Tiny failures, weird bankruptcies, random companies blowing up behind the scenes. At first nobody cares because the names aren't famous enough to dominate headlines. But in hindsight, those small events often turn out to be the early warning signs. That's exactly what happened before the 2008 financial crisis. Long before the housing market officially collapsed, smaller lenders and obscure funds were already failing quietly in the background. And today, we're starting to see similar tremors appear again. Over the past several months, multiple companies most people have never even heard of have suddenly imploded, leaving major banks and lenders stuck with massive losses. In some cases, executives were accused of using the same collateral multiple times to secure financing from different lenders simultaneously. In others, companies allegedly hid huge amounts of leverage through complicated off-balance sheet arrangements, making their financial condition appear far healthier than it actually was. When the truth surfaced, lenders discovered the risks were far larger than they'd been told. And these weren't tiny losses either. Major financial institutions have already absorbed hundreds of millions of dollars in damage tied to a handful of unexpected collapses. Regional banks have also started disclosing stress tied to bad loans and struggling borrowers, triggering sharp sell-offs across the banking sector. Now, none of this means another financial crisis is guaranteed, but it does matter when respected banking executives begin publicly comparing credit markets to finding cockroaches in a building. Because in finance, the first visible problem is rarely the only problem. Usually, it's the first one investors happen to notice. So let's recap the environment we're dealing with right now. Stocks are trading at historically extreme valuations. A massive percentage of market performance depends on just a handful of tech companies. AI spending has exploded to extraordinary levels, Inflation remains stubborn. Interest rate cuts have vanished from expectations. Government debt continues growing rapidly, and cracks are beginning to appear in parts of the credit system most investors aren't even watching. So the obvious question becomes, what are the smartest investors in the world doing in response to all of this? Because if this were just another guy on YouTube warning about valuations, you could dismiss it pretty easily. But what's fascinating is that many legendary investors are already behaving far more cautiously than the average retail investor realizes. Take Warren Buffett. The most famous long-term investor in modern history has been sitting on an enormous mountain of cash, one of the largest cash positions Berkshire Hathaway has ever held. And when someone with Buffett's track record starts becoming more defensive while markets are hitting record highs, people pay attention. That cash pile now represents an enormous percentage of Berkshire Hathaway's entire portfolio, levels the company hasn't held in decades. And Buffett himself recently admitted that he doesn't see many truly attractive opportunities in the current market environment. Think about how unusual that is. This is Warren Buffett, arguably the greatest long-term investor in modern history, publicly saying the investing landscape doesn't look appealing while the stock market sits near record highs. Then there's Michael Burry. Yes, the same Michael Burry who became famous for correctly predicting and shorting the housing collapse before 2008. Recently, he compared today's market environment to the final stages of the late 1990s dot-com bubble. And according to public filings, he's built major bearish positions tied to semiconductor and AI-related companies. Other veteran investors are sounding similar alarms. Jeremy Grantham, one of the few investors who successfully identified multiple historic bubbles before they burst, has warned that current conditions resemble classic speculative excess. John Hussman, another well-known market strategist, recently argued that today's environment deserves to be remembered alongside some of the most euphoric moments in U.S. market history. His long-term valuation models imply downside risks that most investors would rather not even think about. And then you have Stanley Druckenmiller, one of the most respected hedge fund managers ever. What's interesting isn't just what he bought, it's how quickly he changed his mind. After significantly increasing exposure to major technology companies, he rapidly exited large portions of those positions only months later. That kind of reversal from investors with decades of experience usually means something has changed beneath the surface. Now, none of this guarantees a market crash tomorrow. That's important to understand. Legendary investors can be early, sometimes very early. Markets can remain expensive for years longer than anyone expects. But when multiple high-level investors, who built their reputations by identifying excess before everyone else, all begin turning cautious at the same time, it's worth paying attention. And here's the part that should really make ordinary investors uncomfortable. Even professional money managers are increasingly acknowledging that parts of the AI market may be entering bubble territory. Surveys of institutional investors show growing concern that companies are overspending aggressively on AI infrastructure without clear evidence of proportional returns yet. At the same time, several valuation measures for the overall market have climbed beyond levels seen during previous speculative periods, including the dot-com era. One strategist summed it up perfectly with a line that Wall Street veterans understand immediately. The top is a process, the bottom is a moment. And that idea is incredibly important. Market tops rarely look dramatic in real time. There's usually no giant warning sign, no official announcement that things have gone too far. Instead, the market keeps climbing. People get richer. Confidence turns into arrogance. Social media fills with screenshots of gains. Anyone expressing caution gets mocked for missing the rally. That's how speculative manias work. The excitement continues right up until the exact moment it doesn't. And when sentiment finally shifts, it tends to happen much faster than people expect. That's why so many investors get trapped. They keep waiting for the perfect signal to become cautious, the perfect headline, the obvious turning point. But markets almost never give clean exits. By the time the risks become obvious to everyone, the repricing has usually already begun. And this is the part most investors still haven't fully processed. The real risk isn't whether someone believes a crash is coming tomorrow. The real risk is that millions of people think they're safely diversified when they're actually heavily concentrated in the exact same trade. For decades, putting money into an S&P 500 index fund has been considered the responsible move. And historically, it absolutely was. Low-cost index investing has outperformed most active investors over long periods of time. But the structure of the market has changed, because index funds automatically allocate more money to the largest companies. The biggest winners keep becoming an even larger percentage of the index itself. So when a handful of tech giants dominate market performance, your passive investment quietly becomes a massive bet on those same companies continuing to rise. That concentration happened automatically. You didn't consciously choose it. The mechanics of the index chose it for you, which means if one of those major names experiences a severe decline, millions of supposedly diversified portfolios move down with it. And there's another layer to this that makes the environment even more fragile: leverage. Americans have borrowed record amounts of money against their investments. Margin debt has exploded far beyond historical norms. At the same time, speculative behavior is everywhere. A huge percentage of options trading volume now comes from extremely short-term bets that expire within hours. In many cases, people aren't investing anymore. They're effectively gambling on intraday market swings. That kind of behavior tends to appear late in cycles, when confidence becomes so extreme that risk starts feeling invisible. Now, to be clear, this is not me saying everyone should panic and sell everything immediately. Trying to perfectly predict the exact top of a bull market is one of the fastest ways to destroy your returns. Plenty of bearish investors have been warning about valuations for years while the market kept climbing higher. And that's the frustrating reality about bubbles. They can continue far longer than logic says they should. There's even a chance this rally continues for much longer from here. Nobody knows the exact timing, but what investors can do, and what matters far more, is being honest about what they actually own and the risks attached to it. If your entire portfolio is concentrated in one cap-weighted index fund, you may not be nearly as diversified as you think. If you're using leverage or borrowing to invest, you're depending on market momentum continuing indefinitely. And if your plan is, "I'll just get out once things start looking bad," history suggests that probably won't happen the way you imagine, because human psychology works against us during market extremes. When markets are euphoric, most people feel pressure to buy more, not less. And when fear finally arrives, most people panic and sell at the worst possible moment. That's why risk management has to happen before emotions take over. And honestly, the solutions are incredibly boring. Review your portfolio allocation. Reduce positions that have become disproportionately large. Consider broader diversification beyond a handful of mega-cap tech names. Think about international exposure. Think about bonds. And yes, even holding some cash is no longer irrational when short-term yields are relatively attractive. You don't need to predict a collapse. You don't need to become a doomsday investor. You just don't want to be the person assuming the party can never end. Because market tops are usually a slow process. Optimism stays high. The headlines stay bullish. People keep making money. Confidence keeps growing, right until the moment sentiment finally changes. And historically, every major bubble has felt unstoppable near the end. That was true before the crashes of 1929. It was true during the dot-com mania. It was true before the 2008 financial crisis. The hardest part is that nobody recognizes the turning point while they're living through it. And when the shift finally comes, investors don't get to choose whether the moment happens. They only get to choose how exposed they are when it does. So that's where things stand right now. If you found this breakdown helpful, hit the like button, subscribe, and let me know in the comments what your largest portfolio holdings are. There's a very good chance at least one of those major tech names is sitting near the top of the list. And as always, this video is for educational and entertainment purposes only, not financial advice. Every investment decision carries risk, and you should always do your own research before making financial moves. I'll see you in the next video.